Okay, so today we are going to talk about a swing trade that we took on the US dollar, Canadian dollar, that fits right in line with our general methodology that can be used in swing trading or in day trading. Okay, so let's start off by giving a little narrative on how we built into this trade. Okay, so at the beginning of last year, we had tapped in and taken out two major areas of liquidity, the highs from March 2020 and then the highs from January 2016. Okay. So this started to set the stage. Okay. We had a accumulation, okay, right here for a while. All right. That led to a manipulation move into those areas to grab liquidity. Okay. Now, here's where things get interesting, and this is where the market really gives us direction on what to do. So, if you notice on the way higher, we created this imbalanced fair value gap. Okay, and once we took out that liquidity with momentum, we inversed that monthly fair value gap. So that was the first indication that this was a manipulation. Liquidity and highs have already been taken. And with the inverse of this fair value gap, we are now being shown that the monthly order flow is now changing, possibly from bullish to bearish. Okay. We use fair value gaps as a gauge for order flow. If price is respecting bullish fair value gaps like it does right here, okay, and is disrespecting bearish fair value gaps, then we are bullish. If price is disrespecting bullish fair value gaps, which it did right here, and then respecting bearish fair value gaps, then we are bearish. Okay. So as price inversed this fair value gap, it also created a bearish fair value gap on the way. All right. And this kind of sets the stage for what we want to do, because what this does is it creates a monthly fair value gap. Okay. That we are going to look to tap into. Okay. And if price respects this monthly fair value gap, we're going to expect price to draw towards the external liquidity level, which are these lows right here, made after the inverse of that fair value gap. Okay. So all eyes are on this monthly fair value gap that was created back in April 2025. Okay. So in November, we started to tap into that monthly fair value gap. All right. And off that monthly fair value gap, we have a pattern that we look for where price is changing order flow to bearish on the shorter time frames based on that higher time frame analysis. Now, when price came into this monthly fair value gap, as you can see, the short-term price action on the daily chart was bullish. Okay, but if we wait for price to turn bearish on that daily time frame, that gives us the signal that the short-term price action is now turning bearish, which is in line with the monthly fair value gap in the overall monthly structure. If you combine that with an SMT that we had on the dollar index had made a high here where the US dollar didn't. It gave us an indication of price going lower. Okay, so this was actually a swing trade that we took at the end of the year when price had inversed this fair value gap. We took shorts from this area right here, and we took it down to this area first, and then we had a nice area of liquidity and targets down here to aim for, which it eventually hit. Okay, now let's move forward. On the way down, price now created a weekly fair value gap, and this is the basis of our trade. So the draw on liquidity is still this monthly low. So any rally into this can be used as a short down to that level. So when this weekly fair value gap, okay, was made, okay, on the way down, we were then able to use a retrace into this weekly fair value gap to now do the same thing we're looking for on the monthly. Remember, the monthly draw is this external level right here. The weekly draw, okay, will be this weekly external level. And then obviously the main target is going to be this level. But for these purposes of this trade, we are focusing on using the draw of the higher time frame. And then we're going to use a lower time frame, internal to external, to frame that draw. So once this weekly fair value gap was created, we can now use this weekly fair value gap, okay, as an area to enter from, just like we use this monthly fair value gap. And now if we go down to, it was the 6 hour time frame, we're going to see the same thing that we saw on that monthly time frame, okay, except with a weekly, we're going to go down to a lower time frame than the daily. So in this case, it's the 6 hour. You can use the 6 hour, the 4 hour, anywhere in that general range. And we see an inverse fair value gap here as well. Okay, we see short-term liquidity taken out. We see a reverse of order flow from bullish to now bearish. And we were able to take this trade, okay, off that 6 hour chart right here as a short. We put our stops right above that inverse fair value gap. And our target is going to be that weekly external level, which is right here, weekly internal to external right here, which we actually just hit today. Remember, the draw is still to this area because that's the monthly internal liquidity to external move. What we just trade is using that bias. We used a weekly fair value gap to trade internal to external of that weekly move using a 6 hour inverse fair value gap model, okay, to enter a trade and to target that level for just over an 8-to-1 risk to reward trade in really just about 12 days of trading. Okay. Now that price has hit this area, the internal to external on the weekly has now been completed. Profits can be taken. And obviously, runners can still be used to trade towards that monthly external liquidity level, which is down here, which is the final target of this monthly internal to external move. Okay, so that's basically how we trade. We use fair value gaps as internal liquidity. We look for price action at that internal liquidity to trade towards external liquidity, which is the recent pivot lows. In this case, if this was a bullish scenario, it would be a recent pivot high. Okay, so this turned out to be an excellent trade for the community the past couple of weeks. Actually, the U.S. dollar Canadian has been great to trade really since the end of December. And now our students are out waiting for runners to hit this monthly external liquidity, which, could happen at any time, especially with this momentum down here and this displacement below this external liquidity level, which is very, very bearish. Okay. That concludes our trade of the week scenario. Again, this was the U.S. dollar versus the Canadian dollar. On a longer term chart on a swing trading level. But we use these methods every day in our day trading and our swing trading. It's just a matter of adjusting time frames and using the proper or higher time frame analysis and going down to the proper lower time frame coordinated analysis for that particular pair or an equity indice or whatever that you're using to trade. Okay.
Hey everyone, it's Dale here. I hope you enjoyed the video. If you like to trade alongside me and our team of prop firm funded traders every day, then click the link below the video and hop aboard. We are looking forward to trading with you.